Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing Spring 2020 Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Danielle O'Connor, Senior Manager, and Hilary Tanneberg, also Senior Manager. And with that, I will turn it over to Danielle to get us started.
Great, thanks Emily. Hi everyone, thank you for joining us today. In our discussion today, we will spend some time going through the new revenue recognition standards that may have an impact on your organization, and we'll walk through some examples of the new accounting treatment and disclosures. We will also talk a little bit about some things to consider as it relates to COVID-19. At the end, we will briefly go through accounting standard updates that have been recently issued or may be effective soon. First, Emily is going to start us off with our first polling question.
All right, our first polling question today: what type of not-for-profit organization do you represent? A, college or university, B, arts, C, foundation or other grant-making organization, D, health and welfare or community services, E, research institution, or F, other. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And if you're having any difficulty seeing the poll, you may try refreshing your browser. We'll give everyone a couple more seconds. And let's go ahead and take a look at the results. Danielle, back to you.
Great, thank you. Good, it looks like we have a mix from a bunch of different types of organizations, so that looks great. Okay, there are two new revenue standards that will impact not-for-profit organizations, and both will be effective for a lot of organizations with fiscal year ends that are coming up either this summer or fall. We will cover both in our presentation today. So the very first step in the revenue recognition decision process is to analyze each revenue stream and to determine which standard applies. I want to quickly mention that you can consider materiality when going through this exercise. If you have revenue streams or even specific contracts that are not material, those can be scoped out of your analysis, but we recommend that you document your considerations. Consider the specific transaction. Your organization is providing a good or performing a service. Is there a direct commensurate value for both parties involved? If yes, the transaction would be considered reciprocal. This pushes you to the new Revenue Recognition Standard, ASC 606. We will cover this in more detail in a few slides. If there is not direct commensurate value, the transaction is not an exchange transaction, then you will need to consider the new guidance in ASU 2018-08. ASU 2018-08 amends ASC 958-605, which is really just the revenue recognition guidance. From there, you will further analyze whether there are conditions or restrictions. With the issuance of ASC 606 a few years ago, there was a question of whether grants and contracts, and specifically those with governmental entities, whether those would be covered under 606 or if they should be scoped out. This ASU was issued to provide some clarification to that question. As we saw in the flowchart decision tree, the first consideration is whether a transaction is reciprocal or non-reciprocal. It is important when making this assessment that you're thinking about who the customer is. Who is the beneficiary of the resources? Is the resource provider receiving something of commensurate or equivalent value in return? The resource provider supporting the not-for-profit's mission or feeling good about making a donation does not constitute commensurate value. Transfers of assets, typically from a government entity, that are part of an existing exchange transaction between a recipient and an identified customer are considered exchange transactions. For example, payments under Medicare or Medicaid programs. The customer is the patient receiving the medical services, which is an exchange transaction, and the government is the third-party payer. Reciprocal or exchange transactions would be recognized under ASC 606. The resource provider, which could include a foundation, a government agency, a corporation, or another type of entity, is not synonymous with the general public. So if the assets that are transferred to the not-for-profit provide a benefit to the general public, there is not commensurate value received by the resource provider. If the resource provider has full discretion in determining the amount of the transferred assets, the transaction would be indicative of a contribution. The type of resource provider should not override the substance of the transaction. Don't assume because the government is providing funding that it is always for the benefit of the general public. You need to assess the actual contract or transaction. Non-reciprocal transactions should be recognized under ASC 958-605 as contribution revenue. I do want to point out that even though you might have a grant or contract that falls under this accounting method, there is no requirement to present the revenue as contribution revenue in your financial statements. For example, if you have historically presented the revenue as revenue from government contracts, there is no requirement that would require you to change that. You are required to describe the revenue recognition policy, but the way the revenue is labeled does not necessarily need to say it is a contribution. Okay, we have a couple examples we're going to go through. For our first example, University D is awarded a grant from the federal government that requires the university to follow the rules and regulations established by the OMB, incur costs in compliance with rules and regulations established by the OMB and the federal awarding agency, obtain an annual audit in accordance with OMB guidelines, submit a summary of research findings to the federal government, and any unused assets are forfeited and any unallowed costs that have been drawn down are required to be refunded. And the university retains the rights to the findings. So would this be a reciprocal or a non-reciprocal transaction? This would be a non-reciprocal transaction because commensurate value is not being exchanged between the two parties. University D retains the rights to the research and findings and receives the primary benefit of the findings, and the federal government's benefit is considered indirect because the research and findings serve the general public. For our second example, NFPC receives funding from the local government to perform a research study on the benefits of a longer school year. The agreement requires NFPC to plan the study, perform the research, summarize and submit the research to the local government. The local government retains all rights to the study. Is this a reciprocal or a non-reciprocal transaction? This is a reciprocal transaction because commensurate value is exchanged between the two parties, and the local government retains the rights to the study on the benefits of a longer school year. Now, Hilary is going to take us through conditional and unconditional contributions.
Thanks, Danielle. As noted in the flowchart, the second thing to consider is whether the contribution is conditional or unconditional. For a donor-imposed condition to exist, a right of return or release must exist, and the agreement must include a barrier. The right of return or release should be fairly explicit within the agreement. However, to determine if there's a barrier, there are a few things that need to be considered. First, is there a measurable performance-related barrier or other measurable barrier? For example, a specified level of service, a specific output or outcome, or a match. This is a key judgment area, as you will need to determine if the metrics are performance-based and impacts entitlement, or if it's just a best effort metric. The second condition to consider if a barrier exists is the extent to which a stipulation limits discretion by the recipient on the conduct of an activity, such as qualifying expenses or a specific protocol. If the stipulation is not clear or the stipulations are ambiguous, presume that a promise containing stipulations that are not clearly unconditional is a conditional promise to give. The third item to consider is the extent to which a stipulation is related to the purpose of the agreement. Note that this excludes administrative or trivial items. For example, an annual report provided to the donee before subsequent payments are to be received are not considered a barrier. Or a report indicating how grant monies have been spent or a requirement for an annual audit in accordance with OMB guidelines is also not a barrier. However, a report conveying the research findings on a grant for basic research would be considered a barrier as it is related to the purpose of the agreement. One focus is on the point of entitlement and not the probability of it, which we'll talk about in just a second. So for our first example of a measurable barrier, NFPB receives a grant from a private foundation for funding in the amount of $400,000 to provide specific career training to disabled veterans. The grant requires NFPB to provide training to at least 8,000 disabled veterans during the next fiscal year with specific minimum targets that must be met each quarter. There is also a right of release from the obligation. This has already been determined to be a non-exchange transaction. So is this considered conditional or unconditional? This transaction is determined to be conditional. There is a measurable performance barrier in that at least 8,000 veterans, which would be considered a specified level of service, need to be served with minimums of 2,000 per quarter. As noted, there is also a right of release. And again, the likelihood of serving those minimums is not considered. For our second example, NFPE is a public charity that works with gluten-related allergies as part of its overall mission. It applies for and receives a $100,000 grant from a corporate foundation to perform research on gluten-related allergies over the next year. The grant includes a right of return. A statement of approval must be obtained from the foundation for any significant deviations from the general budget. And there's a requirement that at the end of the period, a report must be filed with the corporate foundation that explains how the assets are spent. Again, this has been determined to be a non-exchange transaction, so would it be considered conditional or unconditional? NFPE determines that this grant is unconditional. There is no measurable barrier. The budget is not considered a barrier because adherence to a general budget allows for broad discretion. There is a right of return, however, there are no other requirements limiting how NFPE had to conduct the research. The reporting requirement is considered administrative and not directly related to the purpose of the agreement. Do note that this grant is with donor restrictions because working on gluten-related allergies is more narrow than the overall mission of the organization. And now this brings us to our second polling question.
All right, our second polling question. University of Scholastica is awarded a research grant from the U.S. Department of Energy to study hamster power as an alternative energy source. The agreement requires the university to follow rules and regulations established by OMB, incur certain expenses in compliance with rules and regulations established by OMB and the federal awarding agency, obtain an annual audit in accordance with OMB guidelines, submit a summary of research findings to the federal government, forfeit any unused assets, refund any unallowed costs that have been drawn down. The university retains rights to the findings. How should the university account for this? And your options are A, exchange, B, non-exchange, conditional, restricted, C, non-exchange, conditional, unrestricted, D, non-exchange, unconditional, restricted, or E, non-exchange, conditional, restricted. And I'll give everyone a moment to think about that. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, let's go ahead and take a look at the results. Back to you.
Great, thank you. So the answer here is actually answer E, non-exchange, conditional, and restricted. There is no commensurate value being exchanged between the two parties. The university retains all rights to the research and findings and receives the primary benefit of the findings. And the federal government benefit is considered indirect or incidental because the research and findings serve the general public. The agreement also limits the university's discretion as a result of the specific requirements on how the assets may be spent and that they must be qualifying expenses. And there is also a right of return or release. The audit requirement alone is not a barrier because it is not related to the purpose of the agreement. And it is restricted because hamster power study is narrower than the university's overall mission. Now that we've covered 2018-08, we're going to jump into revenue from contracts with customers, topic 606. Topic 606 moves revenue recognition towards one principle-based revenue standard to be applied across all industries and establishes a 5-step process for revenue recognition, which we will dive into in the next slides. Please note the effective date on this slide is as of today. However, FASB is meeting today to determine if this should be extended or not, so keep your ears and eyes open. The 5-step process is shown on this slide. Step 1 is to identify the contract. Step 2 is to identify the separate performance obligations within the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the separate performance obligations identified. And step 5 is to recognize revenue when or as the entity satisfies a performance obligation. In addition to the accounting changes, there are some additional disclosures required under this topic. The objective of these disclosures is to allow financial statement users to understand the nature, amount, timing, and uncertainty of revenue and cash flow from contracts with customers. Therefore, more disaggregation of revenue streams may be required than what's historically been presented. As organizations find themselves looking for revenue streams beyond that of traditional contribution models, we're seeing more and more complex and unique revenues that this may apply to. You will want to consider all lines of revenue, considering memberships, subscriptions, royalty agreements, sponsorships, tuition, advertising, and licensing, and I'm sure many, many more. Totals should be presented for each of the revenue streams for each year presented. Items to consider is how is revenue recognized? Is it over time as goods or services are provided, such as membership revenues, subscriptions, and tuition? These disclosures should describe the period they are recognized over. Qualitative disclosure considerations include type of customer, type of contract, and customer geographical location. Roll forwards themselves are not required. However, it may be the most effective way to meet disclosure requirements, such as beginning and ending balances of receivables, contract assets, contract liabilities, deferred revenue, and an explanation of how the satisfaction and performance obligation matches up to the payments. So now we're going to dive into some detailed journal entries on how ASC 606 would be applied for a tax-exempt college. Here are the basic facts. One thing to point out is that when students register, they sign a statement accepting financial responsibility for tuition, acknowledge that they must officially drop or withdraw prior to the first day of class in order to cancel the charges, and agree that payment for classes must be made by the due date or they will not be allowed to attend. This creates a non-cancelable contract with the student, and therefore step 1 of revenue recognition has been completed and that they have identified the contract with the customer. So on May 1st, the $500 non-refundable enrollment deposit is recorded for 750 students. This is considered deferred revenue and will be recognized as the performance obligations are met. When invoices are sent on August 1st, no GL entry is required, as the student account system will serve as a subledger. Upon receipt of tuition payments, cash and deferred revenue is recognized. Again, this is deferred until the performance obligations have been met. On August 31st, payment is due on all outstanding balances. At this time, the college has an unconditional right to consideration. Therefore, a receivable is recorded for the balance due, even though unforeseen circumstances may occur that could cause a student to withdraw or adjust his or her course schedule. The net undergraduate transaction price is gross tuition less institutional aid, or more commonly referred to as discounts, but before estimated refunds. The enrollment deposits was recorded on May 1st in entry A. The cash payments were recorded in entry B. The government financial aid is calculated by the school as awarded to students and is considered an accounts receivable from third parties. The ending student payments due of $2.5 million is accounts receivable from students, and the remaining difference is deferred revenue. Again, this will be recognized as the performance obligations are satisfied. On September 14th, the first threshold for refunds passes. The college chooses to bypass an entry here and instead make an adjustment to the transaction price for estimated refunds at the end of the month. At the end of the reporting period, the college updates the estimated transaction price based on the events that have occurred, which would be refunds and refunds owed. The new transaction price of $27.6 million is the transaction price after estimated refunds plus unpaid refunds after September 14th, the first date that refunds are issued. They recognize a portion of the new transaction price based on how much of the performance obligation has been met. At this point, 4 weeks of the semester have passed, and there are 16 weeks in the semester. Therefore, 4/16, or 25% of the transaction price, is actually recognized as tuition revenue. On October 14th, the final threshold for refunds passes. However, there are no withdrawn students or students who changed course load that would require a refund. Therefore, the college recalculates the transaction price to reflect actual refund activity. The transaction price after estimated refunds was the same one calculated as of September 30th. The estimated refunds are updated for the transaction price as of October 31st. And based on the new transaction price as of October 31st, the college recognizes revenue for the month of October. Again, at this point, 8.5 weeks of the total 16-week semester have passed. Therefore, 53% of the new transaction price is recognized, less the amount already recognized, and the remaining amount is recognized as a reduction to deferred revenue, and at that point, you do recognize tuition revenue. Throughout the remainder of the fall semester, the following entries will be recorded. Continue to apply payments received against the appropriate receivables and prorate revenue and amortize the deferred revenue. You will note that these entries potentially will not have a significant impact on your fiscal year end, but would impact any interim reporting throughout the semester or quarter. Here are some examples of the disclosures. I'm not going to read each disclosure, however, I'm going to point out the particular items within each that satisfy ASC 606 requirements. This discloses how the transaction price is determined. It discloses that it's the stated charge for tuition and fees, less tuition discount, equals amount billed to the students. It also indicates how the discounts are recorded and how much is recorded. The timing of satisfaction is also disclosed as being recognized as revenue from student tuition and fees within the fiscal year in which educational services are provided. Another example of the timing of the satisfaction of the performance obligation explains when exactly the summer tuition is recognized, noting it is recognized as the performance obligations are met. It also explains that Summer A and Summer C span 2 reporting periods, and therefore a portion of the payments for A and C are included in deferred revenue as of year end. For sponsored awards, again, you can see as we move through these disclosures that they are disaggregating their revenue and disclosing based on that disaggregation. So here you see sponsored awards. The timing of satisfaction of the performance obligation is disclosed as being recognized as the performance obligations are satisfied, which in some cases are as related costs are incurred. Auxiliary services revenue. The transaction price is not noted in the first paragraph. However, it is disclosed as that they charge a fee directly related to, although not necessarily equal to, the cost of goods or services. Performance obligations for housing and dining are delivered over the academic terms, and consequently revenue from housing and dining is recognized ratably as services are rendered. It notes that ticket sales are recognized after the event, and parking is recognized over the period in which the parking permits have been sold. Again, these satisfy the timing of the satisfaction of the performance obligation. As noted previously, roll forwards are not required. However, this is an example of the roll forward in which it discloses the contract balance, the performance obligation, the timing of satisfying those performance obligations, and also provides the ending balances of each as of fiscal year end. And now I will pass it over to Danielle to walk through another example.
Thanks, Hilary. Okay, for our second example, we are going to use a theater. This theater has a fiscal year end that runs from January 1st through December 31st. Tickets are sold both online and at their box office, and they are non-refundable. The theater has a gift shop and a coffee shop where they sell merchandise and food and beverages. There is a 30-day return policy on merchandise. However, these returns are considered immaterial. The theater also offers camps and other educational programs to children from ages 5 through 18. Camp and educational programs can be canceled and refunded up to 1 week prior to the event. We're going to go through a couple of journal entries. For the first set of entries, we are assuming the theater is recording ticket sales on a monthly basis. So at the end of September, the theater records the cash received for the upcoming holiday show with an offset to deferred revenue since the show has not yet been performed. When the show is performed in December and the performance obligation is fulfilled, the deferred revenue would be reversed and revenue is recorded. Entries C and D show how revenue is recorded for merchandise as well as food and beverages. As the performance obligation in these types of transactions are fulfilled at a single point in time, in this case, when the sale is made, the cash is received and revenue is recorded at that time. For summer camp tickets, we assume again that the theater is recording on a monthly basis. So at the end of May, the theater records all the cash received in advance for the summer theater camp as an increase in cash and in deferred revenue. And then in July, when the camp is held, the performance obligation is satisfied and the deferred revenue is reversed and revenue is recorded. Here are a couple example disclosures. These are the revenue recognition policy footnotes. You can see that they are organized by revenue stream. They include a description of what is included in that revenue stream, how revenue is recorded, whether it's over time or at a point in time, and what the performance obligations are. And here is the deferred revenue footnote, which shows a roll forward of the deferred revenue balances for ticket sales as well as educational programs. And now we are going to move on to our next polling question.
All right, our third polling question. Good Samaritan's Hospital's emergency room removes a splinter from patient A's finger. The total amount due for treatment of services received by patient A is $10,000. Patient A has Medicare, which covers $8,000 of the services and is paid directly by the government to Good Samaritan. Good Samaritan bills patient for the $2,000. How should the Good Samaritan account for the Medicare payment? And your options are A, exchange, B, non-exchange, conditional, restricted, C, non-exchange, conditional, unrestricted, or D, non-exchange, unconditional, and restricted. This is another long one, so I'll give everyone a moment to respond. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. We'll also be sending the slides via email after the webcast. All right, let's go ahead and take a look at the results. Back to you.
Great. It looks like A was the majority of the answers, and that is correct. This would be considered an exchange transaction. Good Samaritan accounts for the Medicare payment, a form of insurance covering the patient, as a third-party payment on behalf of an identified customer to an existing exchange transaction. Good Samaritan has entered into an exchange transaction with patient A and accounts for the $10,000 of patient service revenue in accordance with ASC 606. The $8,000 payment does not create additional revenue, but rather serves as a partial payment against the $10,000 due to Good Samaritan. Patient A is an identified customer of Good Samaritan who is receiving the benefit from the Medicare payment. And I do want to add that in this example, you may want to also consider whether there is any adjustment needed for any explicit contractual adjustments, discounts, and things like that. But to keep it simple, we are ignoring those in our example. Sorry about that. Okay, we're going to move on to talking a little bit about COVID-19, some audit and accounting considerations. I wanted to just pause quickly and mention that Moss Adams has been very closely monitoring the COVID-19 situation and all the guidance that's coming out related to the CARES Act and the various SBA funding options. There seems to be information coming out on a daily basis, and there's a lot of information out there, so it's challenging to sort through everything. We do have a page dedicated solely to COVID-19 on our website. We're posting resources on a pretty real-time basis. So please visit our site and reach out to us if we can help in any way. We could probably fill an entire hour just talking about some of these audit and accounting impacts of COVID-19, but we just wanted to mention a few areas briefly just for you to consider. First, as it relates to accounting for the PPP loans, there is no specific guidance in U.S. GAAP that specifically addresses the accounting for a forgivable loan from a government entity. Right now, there hasn't been any guidance that's been issued by the FASB related to the PPP loan specifically. Our recommendation is that organizations should account for the PPP loan as debt under ASC 470. Following the guidance in ASC 470, a borrower would recognize the entire loan amount as a liability on the balance sheet with interest accrued and expensed over the term of the loan. And then any amount that's forgiven would be recognized in the income statement as a gain from the extinguishment of the loan when the entity is legally released from the obligation. I also wanted to mention, as it relates to the PPP loans, there was a question about whether the funding would be subject to a single audit. The SBA did release communications stating that these loans would not be subject to single audit. As it relates to internal controls, with many organizations moving to working remotely, closing locations, and maybe even laying off or having employees furlough, there's most likely an impact to the internal controls. It's really important that you're considering this, especially as you prepare for your audit. If controls had to change, make sure you're still thinking about proper segregation of duties. If your reviews and approvals are usually done on hard copies of documents, think about how you can still maintain evidence of reviews and approvals. With the move to a remote working environment, has your organization considered cybersecurity risk? Now is definitely a good time to think about how your data is being protected and that employees are knowledgeable about what to spot in malicious attempts to access data. And of course, make sure changes to processes and controls are well documented. As it relates to going concern, liquidity disclosures, and debt covenants, just a reminder to really start thinking about these areas if you haven't already. GAAP requires that management performs a going concern analysis, and all not-for-profit organizations are required to disclose the availability of liquid or financial assets for a year from the balance sheet date. With the interruptions that COVID-19 brought, will those have a significant impact on your organization? We recommend doing a preliminary analysis or calculation of going concern, your liquidity disclosure, and any financial covenants. If you expect poor results, start talking with your board, your bank, grantors, or anyone else who uses this information. It's better to be prepared and proactively work through it. And this brings us to our last polling question.
All right, our final polling question. Based on the impact COVID-19 has had on your organization, what are you most concerned with? And your options are A, accounting treatment, how to account for funding, whether a single audit will be required. B, gaps in internal controls, including cybersecurity. B, potential growing concern. C, potential growing concern. D, poor results shown in liquidity footnote. Or E, not meeting debt covenants. And I'll give everyone a few seconds to respond. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. All right, just a couple more seconds here. And let's go ahead and take a look at the results. Back to you.
Thanks, Emily. So it looks like it's a pretty good mix between all the different areas. I know COVID-19 is obviously having a pretty significant impact, I think, on all organizations, some probably more than others, but it does look like it's having a pretty significant impact in all these different areas. So thank you, and I'm going to pass it over to Hilary, who's going to take us through some new accounting standards to be aware of.
Thanks, Danielle. I think that last polling question could have had a F, all of the above. I'm sure many of you could have answered more than one of those questions there. Okay, the next few slides are some new accounting standards that are on the horizon. I'm not going to deep dive into each standard. However, we wanted to provide you with these slides so that you can be aware of things that are coming and the potential effective dates, assuming FASB does not delay any longer. So ASU 2016-01, recognition and measurement of financial assets and financial liabilities. Non-public business entities will no longer be required to disclose the fair value of financial instruments. This also eliminates the requirement for public business entities to disclose the method or significant assumption used to estimate fair value for financial instruments measured at amortized costs on the balance sheet. And note that under this standard, public business entity does not include not-for-profits and employee benefit plans. As you can see here, for public business entities, this is effective for fiscal years beginning after December 15th, 2017, so already implemented. For non-public business entities, this is effective for fiscal years beginning after December 15th, 2018, and early adoption is permitted. ASU 2016-02, leases. This has been a heavily discussed topic. We've been talking about it for several years. Again, this is another one that FASB is voting on or is meeting today to decide if this standard will be effective or delayed. If it is approved, the standard will not be effective until reporting periods beginning after December 15th, 2019 for public business entities, which includes not-for-profit organizations that are conduit bond obligors. And then for non-public business entities, it would be effective for annual reporting periods after December 15th, 2021. Although this standard could be delayed, we would recommend that you continue to look at your leases to consider the impact of this standard now. ASU 2016-18, related to the statement of cash flows. This highlights the explanations of the change in cash, cash equivalents, restricted cash, or restricted cash equivalents during the period. This is effective for public and non-public entities for reporting periods after December 15th, 2017 and December 15th, 2018, respectively. ASU 2018-13 is more fair value measurement changes, and this is mainly focused on disclosures. As you can see, it's going to remove the disclosure requirements for amounts of and reasons for transfers between level 1 and 2, the policy for timing of transfers, the valuation process for level 3 fair value measurements, as well as changes in unrealized gains and losses. In addition, it modifies the disclosures related to the roll forward of level 3 fair value measurements and also impacts NAV or net asset value investments. This is effective for fiscal years beginning after December 15, 2019. ASU 2018-15 related to cloud computing. Not sure how many people or organizations this accounting standard would impact. However, be aware that there is an accounting standard coming. It's effective for it's effective for public business entities for annual periods beginning after December 15, 2019, and entities other than public business entities. It's effective for annual periods beginning after December 15, 2020. ASU 2019-03 related to the definition of collections. This modifies the definition of the term collections and requires disclosure of the policy for the use of proceeds when collection items are removed from such collection. This is effective for years beginning after December 15, 2019. ASU 2019-06, intangibles, goodwill, and other business combinations and not-for-profit entities. This extends the private company alternatives from topic 350 to topic 850 to NFP entities. There is no effective date as of right now. The amendments will be effective upon issuance of the update. ASU 2020-04 is reference rate reform, and this is for contracts, hedging relationships, or other transactions that reference LIBOR or another reference rate expected to be discontinued because of reference rate reform. The expedients and exceptions do not apply to contract modifications made and hedging relationships entered into or evaluated after December 31st, 2022. Except for hedging relationships existing as of December 31st, 2022, that an entity has elected certain optional expedients for and that are retained through the end of the hedging relationship. And this brings us to a close of our presentation. Emily, it looks like we might have a couple minutes for some questions. Have any come through?
We do have some questions. If you would like to ask a question for either of our presenters, you may type that into the Q&A window and hit submit. Let's see here. Does furthering a resource provider's mission constitute value received under ASU 2018-08?
Yeah, great question. This does not, as there has to be direct commensurate value to the resource provider. So although it may be related to the overall mission, it has to be direct commensurate value. And you'll keep hearing that over and over again. But no, furthering your resource provider's mission does not constitute value under ASU 2018-08.
Thank you. Let's see. If an annual report is required to be filed in order for the organization to receive their payments, is this considered a barrier?
No, this is considered an administrative requirement and is not a direct relation to the purpose of the agreement. And it can sometimes get confusing as you look through what is considered a barrier under this accounting standard. But again, administrative or trivial items are not considered barriers. Again, a report that specifically reports on the research findings of a grant would be considered a barrier as that's directly related to the purpose of the agreement. But a report indicating how the grant monies were spent, an annual audit in accordance with OMB guidelines, those types of administrative or trivial items do not represent a barrier.
Thank you. Let's see. Can you clarify donor restriction versus donor condition?
Sure. A donor restriction is really, it limits the use of the contribution, but it doesn't affect whether the recipient is entitled to the contribution. A donor condition would need to be substantially met before the receipt of the assets is actually recognized. So as an example, a donor restriction is usually something that is restricted for a particular purpose, so maybe a specific program that your organization has, or it's paid out over time, so it's restricted by time. Or a donor condition, you would have to meet something to be able to obtain that money. So as an example, maybe you have a matching contribution where you are required to get contributions up to $50,000, and once you meet that, a donor will make a matching contribution. So that's that condition would need to be met.
Thank you. Okay, I thought that the FASB also deferred the RevRec standard due to COVID-19.
So that one, specific to the revenue recognition standard, as of, I guess, this morning, I don't know if the final vote has come through, but as of this morning, the deferral related only specifically to franchisors for ASC 606. The lease standard applied to all entities, but there was a specific scope out for the revenue recognition standard.
Great, thank you. Let's see, we do have a lot of questions here. Let's go with, oh wait, hold on a second. We've got, do you know if Moss Adams will provide a template for going concern analysis that we can use, or should we develop our own?
Yes, we do have a template.
Oh, sorry.
Yeah, we have actually a couple different types of templates. So that is something that your audit team should probably be able to help you with. If that is not something you're able to get from them, reach out to Emily or Hilary or I, and we'd be happy to send that over to you.
Thank you. Okay. For a donor-imposed condition to exist, must both conditions exist? Can it not be one or the other?
I'm not sure I totally understand that question. I think the important thing to remember, though, is that a donor condition limits, the right, the entitlement to those assets. A restriction isn't going to limit your entitlement. It just restricts how that money should be used. I'm not sure if that answers that question or not.
Okay, thank you. Any thought on whether the forgivable loan could be treated as conditional contribution?
Right now, as I mentioned, there's not really any specific guidance on how they should be recorded, but I know Moss Adams and I know some of the other Big Four firms are thinking that it really should be recorded as debt, and then once it is, once the portion that is going to be forgiven is known, then you would basically record that as a gain. So as of right now, that's kind of our stance, although, as I mentioned, a lot of with all this COVID-19 stuff that's going on, there's new guidance and FAQs coming out on a daily basis, so that could potentially change, but that's kind of where we're at this point.
Thank you. Let's go with, can we use the PPP loan for paying off liabilities in 2019 relating to rent escalation costs. Invoices are dated April 2020, but those were accrued in 2019.
Yeah, Danielle, I can take this one. Again, there is no official guidance out there at this point. However, to be conservative and on the safe side, it's recommended that you don't use that PPP loan except for expenses that have been incurred and paid since that money has been received. So if it happened before the money was received but paid after, we would still, the recommendation there is that you go ahead and not pay for that. It needs to be things that have been incurred and paid since the loan has been received.
Great, thank you. And that is just about all we have time for today for questions. I know that we have a lot that we didn't have a chance to get to, and we will do our best to follow up with you after the webcast. Huge thank you to Danielle and Hilary for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And we also invite you to join us for other sessions we're hosting as part of our webcast series. We'll be hosting a uniform guidance session tomorrow, May 21st, as well as higher education accounting update on June 23rd. We've also included a link to our not-for-profit and higher education webcast series. Be sure to check this regularly since we continue to add new sessions to the series. You can also access these links in the slide deck and handouts widget. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.